Hey everybody, welcome to this episode of Finance This Property That. Welcome back, Troy, the planner behind my portfolio. Well,
Nice to be
lack
here.
of portfolio. It's getting there. Mate, how you been?
Really good. Willow Wealth Partners is growing and scaling so quickly, and like from your business, you take it in strides, and every day is a building block.
Growth, great, isn't it?
Yeah.
Yeah, it's love it. It's we're going through that as well. You might need a bigger office though, I feel, if you're growing.
Yeah, definitely need to upgrade it at some point.
Yeah. Jess, how's she? New baby.
Jess, my business partner, has just had a little baby Oliver, 3 months, 9 kilos. He's a monster.
She's not a very big human.
Yeah. He's currently unable to use his front strap baby holder. He's too lanky. Yeah, she's back in the business. The fun of being a business owner as well.
Yeah, that's another sort of growth problem. It's not business growth. Your baby's growing too fast. But that's exciting. The first Willow Wealth baby.
Yeah, Oliver is going to be a financial advisor. So if you see, your children that you're having now needing a financial advisor in probably, 20 odd years time, Oliver will be there as part of our succession plan.
Oh, I heard he was already working in the business.
Yeah. Working behind the scenes, doing the paper shredding.
Yeah, you know those stamps. Yep. Eating the paper. All right. But really appreciate you taking the time to come in today. It's going to be a bit of a different episode. Like I said, I wanted to introduce you today as the planner behind my portfolio, and want to talk about 3 things that I guess when I'm speaking to clients that are business owners, or even if they're not, talking about my journey through financial planning, why I've used it. But, we're going to talk about when you first looked at my position. What did you see that I couldn't see? How you've helped me separate business from personal. And also, my vision is to empower financial legacies for generations. It starts with my daughter. And I'm sure other parents want the same. Well, hopefully they want the same for their kids to not, like in this current environment, not have them stressed and like that. So want to really talk about what tips or what parents shouldn't ignore and what they could be doing now.
Yeah, easy.
Sound cool? It should be pretty easy. It should all be in your head. Like you should know my plan, like all your 500 other clients.
It's strange. Like I've had clients in the past go, I know you might not remember my exact situation, and I feel like I've got currently most of my clients mapped out, embedded in my brain, partly from trauma. In a good way, looking over a lot of things. But you mentioned for business owner clients, I feel like a lot of business owners, whether they're in professional services or in trades, are really good at doing what they're doing. They can go out and earn that, 300-500 grand a year plus. They're just not sure how to extract the wealth. And that's the biggest thing that we look at. And it's probably what sets us aside from other advisors that don't actually look through to, the trading entity side and work alongside their accountants.
Because you're an accountant, like by trade, you're an accountant, aren't you?
I do have accounting degrees and financial planning, but from my side, I really enjoy working with business owners. I really enjoy picking apart their financial statements and just seeing, if the past 4 years, past 5 years, you've had a lot of retained earnings in a company, that you don't necessarily need. Like, how do we actually bring that out? So, one, to reduce risk. So, if you got sued, your money's going to be sitting in the company. How do we actually move that down so you're not potentially having that money at risk? Less important for say your type, but of company. But when we look at things like trades, if someone gets electrocuted and you're potentially liable, how do we make sure that you still have running capital in the business, but the excess money is moved. And then, also making sure that the business isn't your only asset. So that's the other thing that we see for the retirement end of business owners. They might have, a $3 million business, happy days, but they haven't been investing the money along the way. Or for some professions, they might earn great money along the way, but there's no value once the principal leaves the business. So it's how to make the most of it. With being business owners, a lot of risk. You've got to make sure that you're extracting that wealth along the way, using the time to retirement on your side so that wealth can compound, whether it's leveraged into property and using that as part of your strategy, or building alternative assets to complement your property strategy.
And I guess from, like you were talking about all sorts of different types of business and the journey or the stages where they could be. So when you saw, let's make it about me. When you looked at myself and like a mortgage broker, fairly new, not new to the industry and not new to finance, but new to a new business owner, right? Like, so October 2023, that's when the business, I was a business owner. And when you looked at my spread of stuff, don't need to get into specific numbers or anything, but what did you look at that I didn't, I would never have picked up on?
It's, luckily for you, you've got a good accountant. So
shout out to Morgan.
The structure was sound, and that's probably for new business owners. I think speaking to your accountant up front is one of the best things that you can do, and look at, not only just I can get a company straight away, but look at, the actual flow and effect of that. So, having a trust in place potentially to be able to move income around. What we see for a lot of new business owners, and even ones that have been running for quite a few years, is that, the first year, quite slow. You're just basically getting your foundational revenue through. And you might, the first few years, you're trying to get back up to a normal wage. And because I know that that's for our business, we come off quite a nice salary as a financial advisor to, pennies as a business owner. But the structure is really important, and it gives you flexibility down the track. So, key thing that we find that's wrong with most business owners is that they don't have the flexibility, not now, but in future years. So think of, if you're a business owner and you've got 500 grand profit, you might be paying yourself 190 grand. If you own the company solely in your name, you don't have many options to take that extra money out of your company. We've got Division 7A loans, which not a great fan of, because it's going to come back and bite us. Or we can do dividends and we get our tax credits. We can employ other people, but realistically, without some more tax planning in place and some foresight of where the business could go, it can really come back to bite people. And then once the structure is in place, it's then, who do we want to stream the money to? So for most people, even if they've got the right setup, how do we then start extracting that wealth to things like, adult children, or out to spouses and out to other entities to build wealth?
Yeah, and I guess when you say it like that, I was just reflecting about structure, because my niche in lending is debt structure and strategy, and planning that over a long period of time, and not really knowing. I literally did that for myself, but without actually. You've just articulated it so well. Speaking to the right people, having the right team behind you, and setting it up. I like to make people's lives as easy as possible, right? I kind of already knew my structure was pretty sound, because that's the first thing I wanted set up, because ultimately that's the thing that will drive everything, but didn't realize how it actually made your life a lot a lot easier, and then obviously it's very easy for you to communicate with. I mean, because you already know Morgan anyway. It's very easy because now the team's communicating. I just go do what I need to do.
Correct. And that's what business owners need to do. You need the right team in place. You need the right accountant, advisor, mortgage broker, just to make sure that, one, at a structural level, you're not going to be paying tens of thousands of dollars more in tax in 3-4 years' time. But also looking at the opportunity. So, for your situation, looking at rapid growth as well, and having excess profits there, it's looking at other structures like a bucket company, for example, and being able to stream some of that income to start building wealth, not only for you, but also as a legacy, for your daughter. Yeah.
And what else did you see that I didn't? Because I'm pretty slack with admin. I say that to my staff, man, if you need me to do admin, I'm pretty bad at it. You probably have to remind me 3 times. I think there was a couple of other things that I didn't pick up that you picked up around, what was the estate planning side of things?
Correct, yeah.
And how many business owners do you see that don't plan, like they plan all this, I want to create this wealth, but then don't have sort of almost the exit strategy should something happen to you?
We see people with net positions of 10 mil plus that
I'm not quite there, everyone.
Either don't have a will or they haven't updated their will in 20 odd years. So, for example, their previous will has their children having guardians, and it was before they built a lot of their wealth. So it might not truly reflect, what is possible. So it's really interesting from our side. So you've got, one, the will itself, making sure that, if you do have a lot of wealth, looking at different estate planning tools like a testamentary trust, just to protect your kids. So if there is a lot of money there, having a chat to a solicitor and making sure that you've got, a testamentary trust in your will like yours does, to, because if something happens to you, there's life insurance, there's super, there's your cash, properties that all get fed into your estate, and it's making sure that that money's looked after, and future spouses of your daughter, even though as parents you're probably going, no, that's never going to happen.
No, but it's never going to happen.
We want to protect that wealth. So testamentary trusts are a great tool for business owners, but I think as well we also forget about the continuity of entities. So, a family trust can continue on beyond death, and making sure that, say, if you've got a husband and wife, if the husband's out earning $500,000 a year and there's a lot of wealth built in the entities, and, say he might have all of the control over those entities as director and appointer, looking at different avenues of, successor appointers and successive directors, just to make sure that, say if something happened to the husband, the wife can actually take control of those entities and use the wealth how it's meant to be used.
Yeah, I think there was a document that I probably had for about 6 months.
Yeah, and powers of attorney.
Big one. Can you get me the original? I'm like, but you have the scan copy.
Yeah.
It was literally sitting on my desk for about 3 to 4 months, man.
and it's stuff like that. It's sometimes a really mundane, boring paperwork that will come back and bite some people. And it's a bit of foreplanning. They're meant to be living documents. So as life changes, we update these documents. As your entity list grows, or as your thoughts on wealth grows, you need to have not only the, thought of how do I want my wealth distributed, but also around, that longevity of the wealth. How's this all going to tie in and support my kids and their kids and so forth?
Yeah.
Yeah.
There was a lot, going through the process. I'm not afraid. I'm not one to go get advice from someone that should be more, well, they're better at it than I am, right? Like I'm very good at what I do, but that's where I'm like, I'm good at that, but how does that, I've got such a one-minded, like that tunnel vision. You really need people on your side that has got that big scope. So, you know, when you have business and personal, like how have you helped me separate that business success from that, and separate from that personal wealth growing? Because I think I reckon business owners struggle with that because they group it all in one. And that's when they get into trouble.
Correct. It's, you know, looking at the entirety of your wealth as one picture. So yes, we do have business wealth, and your business might be growing rapidly. We want to make sure that we can extract that wealth and grow elsewhere. So, you know, between now and 15 years time, for example, how do we year by year do tax planning? How do we extract that wealth, build it, and also look outside your mortgage broking career and go at a personal level, how you're building wealth? Because, you know, great that you've got, you know, a lot of income coming through, but how do we, you know, for example, developments, share portfolios, your superannuation, how do we build that? So if something ever happened to your business, that you're still protected, you still have assets, and it's separate from everything else.
And I think one of the, you know, just touched on superannuation there. Now, I don't have an SMSF, everyone, and I was told quite bluntly, I'm not ready for one. And sometimes you just need to hear that, right? Because I was pretty keen on, I've got all this money in my super, and it's a pretty healthy fund.
Correct,
But by me not touching it, and you just going, hey mate, look, this place is not performing, let's get into here. I think we got quite a considerable jump in the super in one hand. And you're like, you've emailed me. I remember the email. So he goes, oh, hey, we've just like, your super's just ticked over this amount. And I've just gone, I've only had it there for like 3 months. You're like, yep, just the power of understanding what goes well. And look, it's never going to grow like exponentially every time, but it's just that time of that period. But, you know, you really helped me understand. It's a bit like me refinancing clients. There was a purpose behind the refinance. And as long as there's a purpose, there's going to be value. But you realize that you couldn't sign.
Yeah.
Like I still had to sign off on it.
It's still like, I find we have a lot of chats around self-managed funds for clients.
Yep.
And with superannuation, it's one of those things I go, you know, we're not biased between having investments in a super fund versus a self-managed super fund, because we just charge flat fees. So we honestly, you know, the strategy needs to work to make sense. There's no point in putting money into a self-managed super fund if it's not going to be sustainable. So we need to build up that sustainability. So a lot of the things that we're looking for is going, hey, we're not ready for a self-managed super fund yet, but maybe in 2 years' time, we can pull the trigger. In the interim, this is what we're going to look at. It's one of those interesting discussions that we have with clients, because it's, you know, we're big fans of SMSFs. We're big fans of, you know, where clients also have purpose. So if you've got tradie looking for a commercial shed, great. You know, we can pay the rent, we can do it, but it still needs to work. So, you know, they still need to come to the party and either make it more sustainable now by, you know, pouring in contributions and building up that balance so we can actually buy something that's going to be good. Or we just wait a few years, let it naturally build up. We're, you know, going to contribute in. But it's trying to find that right balance. And honestly, we just don't want something that's going to be negatively affecting you. Or, you know, there's no point in us going out and buying a really small property that's not potentially going to help you. You know, we obviously want to buy something that's going to suit your strategy.
And this is where I struggle, because I've got to blur, I don't want to blur the line between telling people no, and I'm a big fan of lending under SMSF when it's the right thing to do. Business owners need to get, anyone, doesn't matter if you're a business owner or a retail client, you need to get, my one thing is who's given you the advice and can I speak to them? because
Yeah.
just because you tell me you've got the advice, I still need to let them know the numbers, because they're saying, oh, you can do an SMSF. It's like, well, here are the numbers. Do they actually work with the long-term strategy? As soon as one of my clients said, I didn't get advice, it's I've referred a lot of clients to just go, nope, you need to get advice. Sorry, I can't consciously do that deal without you getting the advice, because I don't want to put you in a shit situation down the track where, because once you're in SMSF, you're locked.
Yep.
Basically, you can't extract equity. If you need to get out of the property, or you can't pay the loan, you've got to sell the property. There's other,
and there's big setup fees.
Correct. Cost.
You need to get the right advice. Also, looking at the right property. So we're starting to really look at, clients being basically too emotionally invested in the property. So using something like a buyer's agent to get the right property, look at it from purely the metrics and how it's going to support it. And then we run the numbers, and then also stress testing. So, with self-managed fund properties, we go through stress test interest rates, stress test if, say, the main breadwinner of the family couldn't actually contribute for a year or two, just to see, would the fund actually be able to survive, or would you need to rapidly fire sell the property because you need those buffers in place? And then also how to build that diversification later on over time.
And I think, you touched on, slowing people down and all that sort of stuff. It's exactly the same methodology that I use. I used to say, hey guys, we're just going to go slow here. And then once we get all this right, we can just plug and play, plug in the strategy, and then just start playing, get the right people there, find you X, Y, Z, get you the right advice. And then you can actually grow a lot faster if you just take a little bit of time. When I find that people in my world buy property too quickly, or they grow too quickly, and then they're like, can't do anything. You got to wait, because you're like, you need money, you need income. That income needs to be growing, and you need either cash or equity to do property purchases. It's just like with a business, you need to be earning a profit. With SMSF, you need to be making sure that that's sustainable over a period of time, and it makes sense with your long-term strategy and getting the right advice.
Yep.
It runs in parallel, just talking different asset classes.
We also have people with SMSFs. I think we were discussing this before, where there's a real need for education. So yes, you can lease the property to your business like a commercial property, but you can't lease a resi to your brother. You can't. You can't. We've had the other option of, I'm getting priced out of the market. I really, I've got enough money in super to realistically buy something, and it might be true, but then they go, I ultimately want to live in this property. And you're like, no, we can't do that. You can't use that to get personal gain. It's going to break the self-managed super fund rules, and generally the super rules as early access to super. And if you do break the rules, your fund goes non-compliant, and a bit of a party pooper here, but your fund will go from 15% tax to 47% tax.
Oh yeah, we love paying the tax. Give me 47%. Far out. Like, and funny you say that with the personal use. I actually had a client go, yep, I'm buying this property and it's going to be a holiday rental, and we're going to go up there and use it. And I'm like, I'm not doing the deal for you. Can't do it. Can't consciously do that deal for you. Sorry. You got to go find someone else. And they go, oh, why is that? Okay, you can't use the SMSF for that. And I know you're going to use the SMSF for that purpose. I don't want any repercussions on my business, because they're going to come, who did the lending for you and did you do it? And I record all my notes. Yeah. So I'm happy to pass on that. They didn't buy it.
Yeah.
They kind of went, oh.
And I think, one of the other things that we're going to be looking at for a lot of clients is putting money away. Obviously, in your situation, we're using things like bucket companies and family trust assets to build up and scale up assets, not only for you in later years, but also for your daughter. But there's also other strategies that we can start to use of things like education bonds, where there's a bit of tax incentive. So think most parents, business owners, professionals alike, we stash money away for kids and we leave them in bank accounts, or we start up a share portfolio in our
Dolomites.
on behalf of them. Yes. And where that becomes a problem and where we've seen it is, say we'll have the kids that have had money invested for them. So, it's still actually attached to, say, the mum's tax file number. If you're a business owner, and this is, say, I set up an investment account for a child. It's still technically my tax file number, but it's just like, in their name somewhat. So it's the other option to that is that we set up things like an education bond where it's not on my tax file number anymore. Because the real issue is, say, we're adding a couple of grand a year. It builds up, over 20 years to a couple of $100,000. You as a business owner are now sitting at, the cusp of 47% tax, and then your child wants to buy their first property and yanks out the couple of $100 grand from the investment, and suddenly you're paying, 30, 40 grand more tax. The education bonds allow us to use the same money we otherwise would have used. We can, there's a few nuanced rules around it. So, if I put 10 grand in this year, I can put as much as I want in realistically, but there's a 10-year rule on them. So, next year I can put 12,500 after 10 years. It will be CGT free. But also if we take it out for education purposes, we get tax breaks. Internally it's taxed at 30%, but then as those that invest in shares know, we can collect some franking credits. So the tax comes down a smidge. Those vessels become really handy for business owners who are going to be on high marginal tax rates for a long period of time. Not necessarily as all of their strategy, but it's just one of the little tools that you can use. If you have already got money set aside for your kids, you can use something like an education bond. Have a look through. There's a few providers out there. Read the PDS and terms and conditions.
This is not advice. Yeah, and I guess that's one of the tools we can use as business owners or even non-business owners to create a little bit of wealth for our children. Now, as a single dad, right? And obviously there are other parents out there, single or not, or coupled. What are they actually ignoring? Like, talking about creating wealth and generational wealth. What should parents actually be thinking of? Like, it's hard, I know.
It's a mixture of things. So one, when do we want to give money to the kids? There's no point in, dying with $20, $30 million and your kids have struggled all of their life. So are we looking at, having money? So if you've got newborns, when do we potentially need a bit more money? Where's that going to be funded from? So this is things like schooling. Do we want our kids to, do we want to pay for their university or their trades? Give them a helping hand, and things like, the first property journey. So is now the right time? You're building up your property portfolio, but sometimes taking a step back and going, well, we could help our children out. How are we going to do this? How are we going to fund it? So that's one component. So, potentially like an earlier release of wealth, and we're going to see that with the baby boomers. There's a large wealth transition coming.
Well, the biggest bank at the moment is the bank of mum and dad. So
correct.
it's not of the big four.
You see a lot of people miraculously buy properties because the bank of mum and dad has financed a lot of it. The other component is, back to estate planning. How do we actually, again, building up 20 mil of wealth, how do we take a step back and go, how does that all flow through? How will my kids actually receive it? What tax do they pay? Is there some stuff that we restructure? And then also things like insurances. So, we don't love insurance premiums, but there's a need for it, particularly when you're building wealth. And then as we have wealth, we can then scale it back down. But, you know, things like the child trauma for kids or...
Kids are expensive, man.
Yeah.
Oh, God, I only have one. It's bloody expensive. It's all the stuff you don't think of. Trauma.
And it's like little things as well. So you need to look at, you know, yes, you know, if you passed away, you got life insurance, which most people have in their super funds. But, you know, what if you were actually unable to work, or, you know, what if you got a cancer diagnosis? So you might need to take, you know, 6 months off work. Your business profits are going to take a massive dive. You know, although we don't want to be on the insurance-y side, it's trying to use it as a tool to fill that gap, because ultimately, you know, a lot of the parents out there will sort of agree that, you know, if something ever happened to them, they still want their kid to be able to go to a good school. They still want their kid to have everything that they wanted to, you know, in life. And we fill that gap in the interim by making sure that there's appropriate insurances in place, or that your, you know, spouse isn't going to need to take up a second job to, you know, put food on the table, pay the mortgage, things like that.
Yeah. And I think, that's the whole... That's the other side that people don't... They all love the assets. And people don't like... Who likes spending money on insurances, right? Like that you may only ever use once.
Yeah.
Like, I've used my home insurance once in 12 years, and it was the worst experience ever. And I actually ended up paying more, but it was there, right? It was used, it got fixed. I didn't have to go onto the roof and fix my roof because I'm not handy. So there's always a purpose. It's like, well, it's there when you need it. And if it's set up correctly, there'll be no issues. It's people that go and get these, I reckon with the insurances, especially if they just go, what's that one that's always on the ads? Like, and you just go, oh, you can be insured for like 10 million bucks or whatever. When they just do that, they don't actually have any, I guess, planning behind it or understanding. It's like, oh, I just want to insure myself for $1 million, but you don't even need it. What other stuff do you need on top of that? And that's where the advice process comes in handy.
Correct. So there's, you know, different ways to pay for things. There's, you know, for example, life and TPD, income protection, we can pay through super. We can also pay them personally. Going to a financial advisor will make sure that you're actually paying them in the right space, so we're not paying too much. So, you know, you can pay for your income protection personally. If you're on 47% tax rate, happy days, we get, you know, half of that premium back in our tax return, versus if we paid it in super, we're going to get 15% back, you know, as a deduction for your super fund. So,
but more importantly, not only where you pay it, it's the type of cover you're actually getting.
Correct, yeah.
That's more important, that you're getting the right cover for the right...
That's underwritten.
Yeah, correct.
Yeah, so you can go, like most super funds have insurance, they're called group insurance. You know, tick a general box. They're not looking at you specifically. They're just asking a few filtering questions. But the real crux of it comes when you're at claim time, and they go, you actually had all of these issues. We never ask the questions, but you're not actually entitled to the insurance. So you might have been paying for insurance for 10 years and can't claim it because you had a pre-existing heart condition. You find that out. So, you know, you went through retail underwriting. It is a bit more frustrating to go through because, you know, they might send a nurse out and get blood and get your blood pressure, and, you know, they hassle your doctor or your chiro.
Yes.
And it is very frustrating for a lot of people. But at the same time, as soon as you have your terms of insurance, you know exactly what you're covered for. And they can't adjust, you know, your terms of insurance. They can't go, now you've got, you know, a condition, we're not going to pay it, or we're going to remove, you know, mental health from our policies. They can't do that. So the only thing that they can do is, you know, charge you more every year. So that's what we see with legacy policies. But if you've got a condition and that's developed after you've got your insurance, generally, you know, you're going to be covered as long as your terms of insurance, when they actually underwrote you, you're, you know, truthful. that differs a lot. You know, if you're bouncing between super funds, you're basically resetting your group insurance every single time. So, you know, for example, someone that might have, you know, arthritis, really weird condition to have, but you go, if you have arthritis and you're with, you know, super fund A, and you got the arthritis after you join the fund, you're generally covered. But if you then move super funds, so if you're one of the people out there that jump super funds, just be cautious. If you move to super fund B, you've now reset it. So now it's a new condition because since you joined the fund, it's now on your file, or not on your file, but it will be on your medical record, and that's what they're going to look at claim time.
And that's what you check before even recommending going to another super fund, if that's the case as well. Because I know you did for me, because I said, I've got a couple of things here that could, not injuries or anything, but like, hey, do we need to check this before moving?
Before we even start, we do a insurance pre-assessment.
Yeah.
Really funny, some of the answers we get back. I'm not judging, but it's a way for us to pick up any problems before we even start looking at moving. Because you know, if you've got a heart condition, there's a chance that you could just go, well, look, you're not going to get accepted for new covers. You know, let's look at other options. Let's look at how we can, you know, use multiple different policies. So use your existing cover, and then maybe tack on something like an accident only cover. But it's building the right strategy for you. And I think that's what some people forget is, you know, insurance should be one of those things where it's niched per person and specifically for what you need. So you don't need to go out and get, you know, $4 million worth of life insurance if you don't need it. And it's tailoring, you know, the insurance just to cover what you need. We don't want to be paying more than we need for excessive amounts, because that money's better spent building wealth.
Yeah. And I reckon probably that's the biggest thing parents ignore. It's like and like when you actually have a look at it, people don't want to spend more money. God, I don't want to spend more money, but like I know there's a purpose behind it, like you just explained. I reckon that would hinder any sort of generational wealth if you didn't actually have that extra level of cover. Well, then you can't grow. You basically stopped earning an income. And what I said before, you can't buy property, or you can't buy shares or anything if you don't have income, or you don't have savings or equity, and you actually need both.
Yep.
You can't just have one or the other. It's that protection piece. And I find it with just, you know, even in my industry, like they just go, I'm just going to go here. You know what? And I always encourage them. I said, hey, you can go direct to a insurer, but they're not going to go ask you extra questions. If they're on the phone, they've got a script, they've got to stay to. I used to work in an insurance company. You've got a script, you've got an SLA, and you've got to get the call done in that time. Great. Why not use an insurance broker for general insurance? Like you use that insurance mortgage broker for your mortgage purposes. You know, why not use a buyer's agent for finding your property? They know more about it than you do. They live in that. They live and breathe it. Why not use a financial planner to plan it out? Yes, it's going to cost you money, but what about the opportunity cost, which is what people don't realize?
I think some people also forget, you know, if you go to, like with mortgage broking, you go to bank A or B directly, you're not getting the 40 plus lenders that a mortgage broker can look at and go, you know, we could potentially get better rates, a better valuation on the property. There's different perks, you know, with different banks. Same thing goes with general insurers. You know, you might have for a particular property, one insurer is significantly cheaper. If you go directly to your insurer, they're not going to give you, you know, like the best price because it's not competing with anyone. The other side is the same with life insurance. You know, you can go with, you know, if you look at generally across the top 10 large retail insurers, they all have very similar features and benefits unless you're a surgeon, unless there's, you know, a very niched reason why you need to be in a particular policy. But if you're, you know, in a normal sort of profession, then it mostly comes down to structuring and price. And there is a major price difference between some policies. where you could be paying, a couple of grand more to be going with one particular insurer just because, you've seen the ad on TV. Or it could just be shit insurance.
Yeah, that's the same thing. Your price is determined by policy, your requirements and objectives.
Correct, yeah.
And you can't get a cheap price just because you see, it's like rate. I never talk about rate because it's irrelevant. Rate's determined by your requirements and objectives, and then base that on policy, and then what is the outcome that we actually need to get. And it's the same thing with the financial planning side of things. You've got to look at that holistically, and this is why you pay for the advice, because you go do all the work. People should not be afraid to pay for the right advice. Okay, yeah, not everyone works like you and me, mate. We're quite thorough in what we do. And we know what type of client to take on board, what type of client we know it's probably not going to be the right fit.
Correct, yeah.
You'd pretty much agree on that.
It's finding, that's what we want to, when we started Willow Wealth Partners, taking on the right clients that we can actually help. So, it might not be every client that comes through our door. Some people will give them an education session, for example. Some people were introduced to other advisors because they might not be the right fit. But, for our side, we want to maximize that wealth creation, protect their wealth, but it suits, a smaller segment of the market, the business owners, self-funded retirees, professionals. But they also got to be the right cultural fit. They got to want advice as well. So, sometimes we will actually go if you're not going to come to the party and give us the information that we need to do our job to help you, or if you're not actually wanting to educate yourself and build that knowledge, you might not be the right fit for us. And it's really hard as a business owner to turn away business, but ultimately at the end of the day, we want to see our clients succeed. And we want to be able to make sure that our clients understand, over time we build up their financial knowledge, and they understand that, that we're on the journey with them, and we're building up their wealth. Just like, when you're explaining strategies to clients, you want them to be engaged in that process. So they don't need to know every little bell and whistle or every nuance of the strategy, but, you want them to be informed. You want them to know that you're going to be there to guide them through that strategy. And
if they've got questions, it's an open door policy.
Correct, yeah. And being the sounding board of wealth, I feel is the biggest thing. Clients, with some advisors, they look at sort of like on charging for additional meetings, things like that. That can be really hard when you want to have that open dialogue. We don't want to find out 6 months later that, you've gone to the accountant and set up another 2 entities and all the stuff's going on. And we have to...
What about me? Why haven't you told me?
We have an open dialogue with our clients. We want to be the sounding board. So when, our clients change jobs after age 60, we want to know, because there's other strategies that we can do for business owners, a massive uptick in profit. Cool. Let's start tax planning a little bit earlier and have a bit of thought behind, what's possible. Getting their accountants involved, their brokers involved. I find a really interesting field to work in.
I think the advice field is always going to be interesting. But mate, look, appreciate you coming back on and dropping some knowledge bombs on us about financial planning. Always find it a very tough topic to talk to clients about, but you make it very easy, and we could talk for ages. Probably do a Joe Rogan style podcast for 3 hours if we really wanted to. But mate, tell us, plug your business. How can someone get a hold of you?
So Willow Wealth Partners, you can get a hold of us. Just book a 30-minute complimentary consultation via our website. We're easygoing. We'll give you the honest opinion. So, if you even have a few questions where, self-managed super fund right for me, or, I'm looking at building my wealth, or, if your current advisor is not the right fit, let us know and we're happy to help.
Sweet. And you're on Instagram?
Are on Instagram, yeah, and Facebook.
Yeah.
So / Willow Wealth Partners for both.
You got to get on there more, I feel. I don't feel you got to do more of the educational pieces when you can find the time to do it.
Yeah, that's the hard bit with socials.
It is.
Unlike Dion here that has just pumps them. He's really good at social media.
I just pay someone to do it for me. No, mate. Look, as always, the information on this podcast is very general in nature, doesn't take into consideration your personal circumstances. If you'd like to talk about your financial future through financial planning, you know where to get Troy. And if you want to talk about finance, you know where to find me at Dion Finance Specialist on Instagram, LinkedIn, Dion Fernandez, this website, financespropertythat.com.au. But until then, we'll see you on the next episode.